Once again, making up a date and numbers here. The main thing to review is, of course, the accounts. So cash will be our debit, sales revenue our credit. I'm going to say $200. And a brief description, nice and simple. Cash, sale, recorded. Now we're going to make the other half of the journal entry for the same transaction. The date will be the same, of course, as they happen simultaneously. Our debit will be cost of goods sold, expense, let's call it 100, and we will credit inventory for 100. And I'm just going to go ahead and use the same description. Cash sale recorded. Now we have the same scenario, but this time on account. So there's only one minor change here, and we will see it immediately in our debit, which is account receivable as opposed to cash. Our credit is still the same. And for description, I'm just going to go ahead and write down sale on account. And for the second entry, in this case, it will be identical to what we did before. Cost of goods sold expense is our debit of 100. Inventory is once again our credit for 100. And I'm going to go ahead and write down the same description as above. Sale on account. So those are your 4 review journal entries all done. So we'll move on to something a little more interesting. Note that these entries are quite similar to the cash sale one. The only difference in the first entry is the asset account, which is being debited. In the cash sale, the book shows cash account increased. In the sale on account, the account receivable asset increased. The second entry, which records the decrease in inventory and increase in COGS expense, is identical in both cases. 3 days later, the SFU student decided to return one of the 2 textbooks purchased on May 23rd. The price of the book is exactly half of the bill. The cost to the bookstore was exactly half of the total COGS expense of the May 23rd sale. And we're going to look at the journal entries for the return. We're going to have 2 entries. The first one is to deal with the sales revenue portion that we had in our original entry. The second one will be to deal with the return of inventory. So take a minute here to think about these entries and maybe try them, and we will continue in this same video. So the first thing to note here is the date. So this is 3 days after the original sale. So I've gone ahead and put May 26th in both boxes. So the debit account for the first entry will be sales, returns, and allowances. So this is a good point to note that we do not debit sales revenue ever. Instead, the sales returns and discount go into separate contra accounts. The credit will be account receivable. And once again, after something is returned, the buyer, in this case the student, no longer owes the money. So half of the original AR balance has been reversed. And for a description, we can write down return on account. So that's the first part of the transaction, which has been reversed successfully. Now we have to work on the second part, which, if you recall, was a debit to COGS and a credit to inventory. So we get the book back, so we can add it back to our inventory. And it was exactly half of the 100 that we originally credited. And then the cost of goods sold account, we can reverse directly, and that's what we'll do. Cost of goods sold expense credited for 50, and a brief description. We'll change it up a little bit, gonna have a little more detail here. Inventory return May 23rd sale. So that's all done. You can continue. Note that we do not simply reverse the old entry in the sales revenue account for half the original amount. Instead, we debit sales return and allowances, which serves as a contra account to sales revenue. However, a portion of the bookstore's account receivable does get reversed since the student owes less after the return. If the original purchase was made with cash, the bookstore will simply pay back the cash to the student, credit to the cash account as opposed to AR. In the second journal entry, we do reverse the original entry partially with respect to the dollars or numbers. One of the textbook is returned to inventory, so the COGS expense is reduced. Also, the book is no longer sold. As its name suggests, the sales return and allowances account is not only used for returns, but also allowances for damaged products. In a situation where the bookstore grants an allowance to a customer, only the first entry is made in the amount of the allowance. The description would be something like allowance granted for damaged goods. The second entry is not needed since no inventory is returned to the seller. Finally, let's assume that the bookstore offered 2/10 and 30 terms to the student. He paid the remaining balance for the May 23rd order on June 1st. So take a minute to try this, and we will go over it in the same video. So the first thing we want to confirm is the date is June 1st, because that's when the student made the payment. So we're looking at a couple things here. We're looking at May 23rd, when the sale was made, and June 1st, when the payment was made. We're also looking at the discount terms. We know that June 1st is within 10 days of May 23rd, so the student qualifies for a 2% discount. So I've gone ahead and set the journal entry up. I haven't worked with numbers yet. So $100 is owed to us after the sale and the return 3 days later. So multiplying $100 by 2% gives us a $2 discount, which we should grant to the student. So now we have an idea of the numbers. So we're going to receive cash of 98, right? $100 minus $2 discount gives us 98. The student will no longer owe us money. Recall that he originally owed us 200, and he returned half of the product that he bought from us. So once he makes this payment of 98, we wipe out the full account receivable balance of 100. You notice I've left the line up here. This will be a debit of $2 to sales discounts. So that's where the $2 goes. And I'm going to write a brief description to wrap up our journal entry. Cash collection within discount period. And I'm going to write down the calculation so everybody who looks at it can follow. 100 times 2%. That's your discount. Okay. Note that only $100 is owed for this order, since the purchaser made a return between the original order and payment. Since the student paid in time to receive the discount, the bookstore collects the cash net of the discount. Hence, the cash and sales discount amounts are debited for the correct amounts. The AR account is credited for the amount the student owed after the return. So even under a computerized perpetual inventory system, a physical count of inventory is occasionally done to confirm what is on hand with what is on the books. Often businesses experience shrinkage, which is reduction in inventory due to theft, spoilage, or error. This requires an adjusting entry to write down inventory to its correct value. Let's look at what a physical inventory count for the bookstore might look like. Before the count, at the end of Q2, we note that the bookstore's booked state of value of $1,800 for inventory. A count revealed that the inventory on hand is actually $1,600. So we have a calculation here to figure out the adjustment, and then we have a journal entry to make the adjustment. So take a minute to think about this and try your best. We will go over the solution in the next video.